I want to find companies that when I listen to the earnings calls, the CEOs are incredible. Just people of vision, somebody that when I listen to him, I say, that's exactly who I want to run a business that I own a stake in.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey guys, welcome to another episode of Wealth Strategy Secrets. Today we're joined by Lior Gantz. Lior's father went bankrupt 3 times by the time Lior was 22. At age 32, Lior became a self-made millionaire without any formal education. He has done it through implementing specific principles in businesses and investments. His story includes failing and recovering, years of working 12-hour days, 7 days a week, countless books that he read to guide the way, and a relentless pursuit of sharing the ideas he uncovered. Lior has a wealth of knowledge at creating successful businesses. His investment philosophy marries the timeless strategies of deep value investing with cutting-edge sectors such as natural resources, blockchain tech, and cannabis legalization. His nickname is the millionaire, thanks to his nonstop traveling, visiting over 40 countries and experiencing the most adventurous attractions of each location. He has scuba dived with sharks, skydived, climbed to the top of volcanoes, and rafted in white waters. Lior, welcome to the show.
Thank you for having me.
Yeah, really looking forward to this discussion, Lior. You have such an interesting background, even when you grew up and really how you got into the space, as well as today. I find that, in terms of information sources that are out there, right? There's so many media sources, news sources, talking heads, you name it, right? That I would say have particular agendas, right? And that want you to think a certain way. But what I've found in, discovering you over the past couple of years and following Wealth Research Group, you are one of the few sources of data that I've found that I allow into my filter that's making really, intelligent decisions, understanding trends, providing insights into all the things that are happening in the world today, and also from a global perspective. So I think the audience is really going to enjoy this today, but why don't we start things off with telling everyone a little bit about your background and how it all started for you.
Well, first of all, I appreciate all the compliments. In terms of how I got started in investing and in business, sort of the background has to do with my father's business, which was furniture or upholstery and then furniture. But anyways, it didn't go well. And by the time I'm 13, that business kind of goes under, and I begin to work just because I can't ask my parents for money or anything. So some babysitting, and I'm tutoring in the neighborhood, like basketball, like young kids, 6-year-olds, just the fundamentals, and then I did the scoreboards for basketball games. I got paid for that, handing out flyers, the whole thing. And by the time I'm 16, I'm delivering pizzas and sushi and this and that, and just saving a lot of money, and depositing it in the bank account. So at some point, one of the bankers calls me into his cubicle, and this is like I think around the year 2000. I'm 16 then, and he says, "Look, you're saving a lot of money. Why don't you put it to work?" He kind of prints out from a printer like a summary of why the Chinese economy is going to blow up in a good way, and this was like 2000. So he says, start looking into mutual funds. And then I buy books. I buy like Peter Lynch book and Warren Buffett books. And I'm the kid in high school that has like the history book, and then inside of it there's like an investment book. And I'm starting to put money into the stock market as a teenager. I actually had to get my parents into the branch to sign like a waiver, so I can. I don't know if they do it today as well, but if you're under 18. So then, because I'm Israeli, at 18, you finish high school, you go to the military for 3 years. And when I get discharged, it's late 2006. And because my dad's second go around in business didn't go well as well, he kind of wiped out all the savings he had left. So at that point, I'm 22, and there's no cushions from family savings or anything else. I have to like figure it out on my own. And at the same time, the world seemed to be ending. It's 2007, 8, and it looks very grim. We're going into a huge recession, and I'm trying to figure out what to do. I go to the States, and I actually get into real estate. But the first thing I do from the airport is go into a Barnes and Noble, because I've heard a lot about it. And it was my first time going to the States as an adult, and I picked up a gold and silver book. So at the same time that America is on sale, I also start to understand the world of the Federal Reserve and inflation, and everything that has to do with that. Because up until that time, between 2000 and 2008, I invest in very in a way that's Peter Lynch and Warren Buffett: what you love and what you know, and just stocks. So 2009 onwards is sort of the new investment strategy and the business strategy, where you combine real estate, stocks, alternatives, which is at that point just gold and silver, but grows to be more. But also that train of thought that it's best to be more aggressive when everyone else is exiting the building, or that contrarian view sort of kicks in my brain. And funny enough, in Hebrew, we don't have a word for a contrarian. So it's even like when I talk to then people my age, 25, 26, and I tell them, look, I'm trying to be a contrarian about this recession. I can't even find the right word in Hebrew. Anyways, through that period of 2009 to 2015, I expand my businesses. I open more businesses, and by the time of 2015 rolls around, I'm 30, but I see that other 30-year-olds don't investigate or don't research, I should say, the same content that I am. They're not even interested in that content, and I just found it insane that I can't speak to them on the same level, most of them, and that's how the idea for Wealth Research Group as a free financial newsletter, just to gather my thoughts and put it into writing, came about. But it attracted people that are not just my age group. So 2015, I founded Wealth Research Group. In early 2016, actually, the first articles go out, and it's a free financial newsletter. The idea is to 3 times a week gather everything that I see and read and study in the financial markets and just life in general, with emphasis on economics, investments, and lifestyle, and everything that I talk about with the fund managers, CEOs, etc., and put it in 3 5-minute, 6-minute read articles that are very generic and up to date. And if I see anything interesting that's more actionable, to also put it as a point of reference for people to learn more about. So, for example, my entire portfolio is actually out in the open. If you go to wealthresearchgroup.com/portfolio, you can download my entire stock market portfolio. So it's a marriage of both generic and personal.
Wow, that's awesome. I find it so fascinating how people's background really shapes them, right? And I was actually in the military as well. I traveled to Israel, and I got to spend some time, working with some Israeli soldiers, and it was so fascinating, that they all have to serve, growing up, and that really leaves an indelible mark on you, being in the military, understand what's going on from kind of a global perspective, and also, concepts such as freedom, right? Which I think is really behind the curtain to a lot of investing, right? And what money really means. It's actually trying to create more freedom in your life. Um, and not to mention, the people you get to work with and the teamwork and things like that. But it's interesting how that kind of shapes your view on the world as well. But why don't we talk, Lior? Really specifically, I think investors are really wanting to know, like, just how do you make sense of all the things that are going on today? I mean, it's almost mind-boggling, although we've been here, right, for really centuries. It goes back in time, right, with different wars, geopolitical events, energy crisis, right, all of these different types of things. But how would you kind of frame this whole thing, and how would you really assess all of these different data points within the economy and where we
Hmm.
are in the cycle right now?
Okay. I think that when you look at COVID-19 as an event, you would think that a global crisis would have led to a massive unified corporation, G20, G7, the UN, etc. And it didn't. There was a lot of finger pointing between countries and a very different approach to how to solve this from various countries. Sweden never closed for a second. Australia closed and went very draconian on their citizens. China went zero COVID policies for a year further than the rest of the developed, the big economies. The United States, you had at first a brushing off and then a big problem and then a switch of presidents. You just saw that the globalization period that we've been in since 1945 has ended. And essentially, globalization really kicked off when the United States and the Soviet Union were the clear two victors of World War II, for each for their own reason. And the clashing between them and the atomic fears that both countries created to their citizenry, that the other country is preparing for a nuclear war, birthed a big period of the Cold War. But economically speaking, what it birthed was the Bretton Woods Agreement. And the Bretton Woods Agreement was the underpinning idea that the United States and its allies will have the dollar as a reserve currency backed by gold, and the United States economy will help the countries that want to follow it into Western values, etc., that will fight off the Eastern Bloc or the Soviet Bloc. By 1971, that idea fell apart, and instead of defaulting on a 35-1 ratio gold to the dollar, Nixon decided to do a trick of wizardry and just announce on national TV that they're temporarily cutting the ties between or that gold window, the 35-1 conversion. But basically, he birthed the fiat monetary system or the petrodollar system, where the United States dollar is now used as the reserve currency, not because it's backed by gold, but because it's the international way to transact with oil, especially Saudi oil that will be sold cheaply to its allies. That idea helped the United States continue to thrive through the 70s and 80s. And by the time the early 90s come around, the war, the Cold War, has been won. There's only one superpower in the world. At that point, globalization should have ended. And instead of that, it went into hyperglobalization, where countries that really had nothing to do with globalization or with its agendas, etc., were now added into this idea. And that's why you see in the early 2000s, when America goes into war in Iraq and Afghanistan, that many soldiers are asking, why are we here? What's the purpose of this? What am I missing? And by 2011, with Obama's speech about, hey, we need to shift priorities from the Middle East, we're done here, like there's nothing here for us, to China, And then with Trump's speech in the UN in 2018 saying, hey, that's it, we're done policing everything. Now everyone needs to pay his fair share and build his own military. We're not going to do this for you guys. And then with COVID, really showing that supply chains and globalization as an economic idea, not as a political idea, has fallen apart. We are now entering deglobalization, and that is a very different environment. And in that environment, the first thing you have with deglobalization is all of the existing supply chains need to be rethought. And because of that, you can think about it like a fully furnished apartment. When you have a fully furnished apartment, but your wife doesn't like the furniture, or your husband doesn't like the furniture, and says, hey, we need to replace everything, well, that's very inflationary. If you just purchased the whole thing and now you need to dump it and buy a new, that's time consuming and it's costly. And that's what we're doing right now. We're changing existing systems with redundancies. We need to build them anew because of political risk, because of geopolitical risk, because of economic arbitrages closing between China and the rest of the world, because China isn't cheap anymore. And that's creating inflation. It's creating inflation and sustaining inflation because we have labor shortages in the Western world and in China as well. So in the cycle where we are right now is we are in probably a 5 to 7 year period of re-engineering the way that this deglobalization period will kick off. So everyone's trying to assume their positions. And by the time 2030 comes around, we'll have a nice picture of how this world or this economic system will look like.
Yeah, that's really fascinating, and I really respect your macro view on really understanding the trends, right? Because a lot of times, everyone gets lost in the details because, like I said, certain agendas or certain things that are top of mind. What's the Fed gonna do this week, or this month, or what just kind of came out of the White House, right? Which is impacting things, but understanding these macro trends. And then how do you align, your investing philosophy around this, right? Because I think that is one of the top 3 reasons why investors lose is not paying attention to global and macro trends.
I think that in general, you either are an investor that's active, and then it needs to be a passion of yours and something you love and something you put a lot of work into, or you need to be a passive investor. And there's nothing wrong with that because the world on aggregate is always growing richer. So if you're invested over the long term, over the course of your life, if you're invested in equities and real estate and in anything that's productive, you're going to do very well. So the question is, do you want to do it as a passive investor and kind of have a result that's at par with the growth of the economy, or do you want to put a lot of effort in and see if you're capable of creating outsized returns in terms of your personal abilities and also the amount of time that you're going to devote to this. So, or if you want to do a merit approach, which is basically what I do, which is you match the passive portfolio with an active portfolio.
Interesting. So you are really bullish then in terms of equities, real estate, just businesses investing into the future right now?
Always. I've never been not bullish. Over the course of, for myself, I'm going to be 39 in 2 months. In the next 30 years, I'm going to be a buyer of equities, a buyer of real estate, a buyer of stocks, a buyer of businesses, a buyer of gold, a buyer. I'm going to be a buyer. I'm going to keep buying more assets. So, I do think that the world will be far richer 30 years from now than it is today, far more efficient, far more beautiful, far more everything. It just, on average, some people will lose, some people will gain, but on average, GDP of countries will be bigger. Everything will be better. And that's, if you look at human history in general, that there's never been a period where that's not true. Just pinpoint to any year, take 30 years forward, and you can be bullish. Now, if you're 55 to 65 and thinking about retirement and throwing away your active income altogether and living off investments and savings, then you need to figure out something else, which is time risk management. Okay, timing the market, and things that have to do with risk on and risk off, because you're not a buyer of equities anymore. You're a buyer and a seller, or you're a buyer and you're taking money out through dividends or other cash flowing means. And if you do that, then yeah, you need to think in terms of cycles way more. You need to think about are we at an end of a long bull market? Are prices elevated, etc., etc. But for me, it makes no sense over the long term to think about that. If I look at, for example, just the easiest example is Amazon stock, which was $100, I think, at the height of the dot-com bubble. It was $6 at the bottom of the dot-com bubble. And if you split adjusted, it's worth I think like $1,500 today. So even if I bought at the height of the dot-com bubble and just kept buying all the way through to the bottom, and then kept buying all the way up, I will have made a fortune. And that's because I picked the right business, and I didn't have to time anything over the long term. And so it's just a matter of your age group and whether or not you're just a net buyer of equities, or do you need to start thinking about living off of those equities? And when you do need to start thinking about that, that's when you need to change your thinking to preservation and defensive.
Yeah, good point. So if you are a buyer right now, look at, BlackRock, some of the top institutions, right? People taking money off the table, right? And they're being very liquid at this point in time. The VIX is really high, right? So I think people are looking for opportunities to be a buyer. Any particular sectors stand out for you in terms of buying?
I think that because globalization is contracting, the arbitrages and anything that benefited from the relationship between cheap labor in China and the consumer economy in the United States, or anything that's multinational in nature, is going to be going through this adjustment period. Any big business that has to change a lot of its moving parts is going to take a while to recover. I think that so those are companies that I'd love to see, first of all, recovery, and then to accumulate shares in. And if I already have shares, just to follow the quarterly earning calls and to understand whether or not management is doing well or not. Because the ultimate risk is basically losing your competitive advantages. I don't care about companies going through some recovery period. That's fine. Every business goes through that. But if they are losing to other competitors that are doing it better, that I do care about. And then big tech or tech in general will suffer more from these very high interest rates compared to the zero interest rates of last decade. And so what I really want is the same always. I want to find companies that when I listen to the earnings calls, the CEOs are incredible. Just people of vision. Somebody that when I listen to him, I say that's exactly who I want to run a business that I own a stake in. And so it doesn't matter the sector that much. You can make money in any sector and fight off any sort of change or crisis. It's about the actual people running the company. So that's what I care about, and that's what I focus on in terms of stocks. In general, yeah, I'm very bullish on stocks, and so I'm buying stocks. I'm buying stocks today. I'll buy them next week, etc., etc. So I think that the only thing I do, which is defensive, is create a price limit. So the fact that I love a company and listen to an earnings call, and I love everything that I heard about the earnings call, doesn't mean that I'll go and accumulate more shares. There's a price that I'm willing to pay for what I heard. So that's the way to be defensive, right? To set a price where you think this business should be worth. And sometimes, I listen to 7 or 8 or 10 quarterly reports. So a year and a half, 2 years can go by before I buy a share of a company that I like. In terms of real estate, in America we have a shortage of homes. It's not gonna go away. The millennials have postponed marriage a lot. First of all, because they were not comfortable financially. They lived in their parents' homes as a general rule of thumb for longer than previous generations. They went to college for longer periods of time because of you need a first degree and a second degree, etc. And then the COVID came and postponed marriages and dating for 2 years. So now you have an entire generation getting married. You have the generation ahead of them, the baby boomers that are bigger in size, mass retirement. So the millennials are moving up in the corporate ladder, have more money, getting married, forming families. They need homes, and builders have just not built enough homes. So couple those two things together, and I don't think that we are entering a 2008 environment in real estate, no matter how high these interest rates will go. It looks like we're going to be in a period where people are going to be very selective, and they're going to think twice about about purchasing a home. There's not going to be like 100 offers above listing on every single family that comes to market. But yeah, the market is normal right now. I would call it normal for the single family homes. As we go into these more large transactions, either the commercial real estate or just institutions buying and selling large multifamily units, 300, 400, 500 doors amongst themselves, that's where I see a real freezing up. It looks like buyers are saying to themselves, these sellers are not going to be able to refinance. And the sellers are thinking about, yeah, we will be able to refinance. We don't need to liquidate this portfolio just because of higher interest rate. We're going to figure it out. So because of that, buyers are not buying, sellers are not selling. They're at a standoff. And that's creating a major slowdown in the housing sector, and that obviously plays into this recession theme in the United States, because housing is a huge sector of the economy. It's the largest sector of the economy, and it created 70% of America's millionaires in its history, including the former president, etc. So housing is a big deal in America. Construction is a big deal in America, and until such time as the Fed offers more clarity that they've stopped raising interest rates or halted it or paused it, anything that will give solace to these interest rate sensitive industries, that the Fed has kind of reached whatever point it wanted to reach. Until such time, we will have some freezing up.
You had such a great analogy a couple of months ago, Lior. You were talking about doing some F1 simulation and comparing that to the Fed. And, if you've ever, taken a track car, into corners, right, it's all about braking before you get into the turn and then accelerating it through it. And you were making the analogy, right, that the Fed is doing the opposite, right, of what they should be doing, trying to manage inflation. So what are your thoughts in terms of, where we are with the Fed right now and inflation?
Okay. So we are, by definition, in an inflationary decade. So the Fed's role, just like any central bank, is to stabilize prices. And that doesn't mean to do what Paul Volcker did, which is basically raise interest rates double or double interest rates overnight, plummet the economy into a recession, so that prices will come down because demand will come drastically down. That's one approach, and it was appropriate at the time that Paul Volcker was at the Fed, and appropriate for the time of the 1970s when the Fed several times said, hey, inflation is under control, and then it went out of control. So the public was in real distress as to these failures. So they had to be drastic. The Fed right now is far more gradual in what they're doing, and yet they've done a lot. So I think at this point, what they will start to think about is, one, whether or not continuing to raise interest rates has any benefit. In other words, does raising it to 6% really going to move the needle? And if it won't, can we just stay here for a long time? Can we just create a new normal for interest rates? And that's what I think they will choose. They've obviously stopped hyperinflation, which 2021 was it was borderline hyperinflation. You saw prices of lumber going nuts. All commodities went really through the roof for a combination of reasons, just not just demand inflation, but just supply chains opening up. You close the whole, the core of the economy and opening it back up. It created a lot of issues. But once things start to normalize and stabilize, and they just couldn't afford to let them do it on themselves, at the pace of a free market, they had to intervene at some point, and they did. And then Russia and Ukraine go into war, and that brings more pressure to the prices of energy. What you have essentially is a Fed that has to do more than usual, and that's what they did. They did a lot, and now I think that what they'll choose to do is either keep it here for a very long time, so at 5% for a very long time, and continue to sell their balance sheet off and reduce their balance sheet, because anything they do now to reduce their balance sheet will help them later if they need to combat a recession. But in my assessment of this, I think that the Fed's role was to just smoothen out the period of inflation, make it as livable as possible. But they can't change the fundamental demographic trends and geopolitical trends that have birthed this inflation worldwide. They just help us to live with it in a way that's manageable and not crisis or panic. So when they fail, it looks like 2008 or like 2020. When they don't fail, it just looks like a long, very lengthy cycle that has to play out, and that's what's happening right now. People are just adjusting to these higher interest rates, to this new employment environment, and I think that what we'll see in the second half of the year is whether or not we'll actually go into some sort of a GDP recession. And if we do, then I think that they will start to gradually cut. I don't think that they will handle this as a crisis, no matter if we actually go into a recession. But I don't see a severe recession. I don't see a 2008. I don't see a crazy environment happening, because when I listen to earnings calls of CEOs, and I've listened to 17 so far this earnings season. So in the past 5 days, I've listened to over 17 hours worth of Q&A sessions, probably 150 questions posed to CEOs or from various sectors. Every company in the world is doing everything it can to transition into this new world of higher interest rates, margin cutting, all the deadweight employees out of the door, pleasing shareholders with profit margins and net income. So in my world, we are already so much in a recovery that it just takes a lot of time to transition the entire economy into the recovery. But a lot of, if you think about it almost like a sleeve where you go into the sleeve and then come out, then a lot of the companies are already coming out. But there's more that need to come in. It's just a big, long process.
Yeah, really interesting take on that. I also find it fascinating that there's so much talk now in mainstream media about devaluation of the dollar, right? Which,
Okay.
it's really the whole BRICS nations has been going on for years,
Yeah.
and the move off of the petrodollar. So a lot of movement there. What are you thinking from that perspective?
Yeah. The BRICS is an association. It's not even a real treaty between these countries. So I don't see them rolling out a joint currency or disrupting the dollar for now. I do see that. I do think we entered into a bear market for the dollar that will last a few years. So I do think that the dollar will depreciate in value compared to other fiat currencies. You can track that on the DXY. But I don't feel threatened by Brazil and Russia coming up with a currency with South Africa and India and China to compete with the dollar. For now, the dollar is sort of the dollar's relationship with the world is sort of a broken marriage where the divorce would look even worse. So there's no reason to go through the divorce unless you find already an alternative. And right now there is no real alternative. So that's why central banks are buying gold at record amounts, and gold is trading at all-time highs versus virtually every fiat currency in the world except for the dollar. But by the time this posts, it could be also at an all-time high versus the dollar. So um, just to kind of sum it up, the dollar has its issues. It's not going to be the reserve currency for 100 years more. But for now, it's certainly not threatened by other fiat currencies. I do think at some point it will be, and it will probably continue as a reserve currency alongside another reserve currency engineered and brought about by the Chinese. But just keep in mind something about the yuan. The yuan is not a real currency. It's basically pegged to the dollar. We've never seen a free floating yuan. So unless until such time as China says, "Hey, we want to be a currency just like the U.S. dollar. We want to have rule of law. We want to be an open economy. We're not going to manipulate our currency, and then we can see what that currency looks like." I think only then will other countries be willing to really buy into this idea of buying yuans. For the meantime, they buy dollar, euro, some Swiss, some yen, and gold.
Interesting. So, do you have any type of hedging strategy in place right now? I know you're a buyer of precious metals. What does your portfolio look like, or do you have some type of hedging strategy in this market today?
Hedging against what?
Devaluation of the dollar. Like, are you doing some foreign currencies, or do you have precious metals or life
Precious metals.
insurance or sometime? Yeah.
Yeah, I have. I mean, anything that's valued at U.S. dollar terms, um, which is everything in the world, is a good hedge against dollar devaluation to a degree, right? But what really is the hedge is the ratios between things. So, for example, if I choose to buy more gold today than real estate, that ratio interests me, right? The gold to real estate ratio. In terms of uh, saving in pure fiat or doing or not doing that, I almost never save anything in fiat. I save enough to have a cash position that I can deploy, but for the rest of it, it's not going to be just in pure fiat. It's definitely going to be either in alternatives like gold or silver, short-term lending. So any debt that I can be involved in at 10 or 12%, for a year or two, I will do that. and mostly stick to stocks and real estate.
Great. Lior, if you could give our listeners just one piece of advice about how they could accelerate their own wealth trajectories, what would it be?
Partner up. I think if you can find at least one, but preferably two people that are as excited about investments as you are, and form some sort of a brainstorming alliance, a business endeavor, etc., and live your life in a way that you don't have to do all the thinking. I think that will be my main thing. If you look at Buffett, he has Munger. If you look at Big Bill Gates, he will tell you that he had a lot of help, like a lot of help at Microsoft. And we all know today that Steve Jobs had Tim Cook by his side for those years. But I can go on forever. I mean, even Beyonce has a voice. How do you call it? Like a coaching for her. Yeah. So even Michelangelo, like a painter, even he had coaches, etc. So no matter what the solo sport is, you need to be around at least one more person, but preferably two more people that form some sort of an alliance. And I think that will really help you in life more than anything else that I can say on a podcast.
Love it. Yeah, it's really increasing that relationship capital, and in many different ways, whether it's with your business, your family, the coaching, your health, any type of investments in relationship, and constantly thinking about it's like Jim Rohn's quote, right? That you're a product of the 5 people that you spend most of your time with. So are those people really elevating you or not? Yeah.
That's a classic. Yeah.
Yeah. Awesome. Lior, I really appreciate you coming on the show today, really sharing such great insights with the audience. I think that's going to be super value for people. And if they want to learn more about Wealth Research Group, or they want to connect with you, what is the best place?
Subscribe on the homepage.
Okay. And we'll provide a link in the show notes to wealthresearchgroup.com, right?
For sure.
Awesome. Lior, thanks again for your time today. Really appreciate it.
Thank you.
All right. Take care.